Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi, everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Andrew Mushbaugh, and I'm joined, as always, by my co-host, Trent DeBruin. And today we're going to take a deeper dive into one of the bigger planning opportunities in retirement, which is Roth conversions. And we'll break down this broader topic into a few different areas, which will start as usual by, number one, breaking down what a Roth IRA conversion is from a higher level. 2, looking at why you'd want to consider making them in the first place. 3, what you need to be aware of from a tax perspective and the factors to consider before making Roth IRA conversions. 4, the key windows where Roth IRA conversions are the most impactful and what you need to be aware of in each window. And number 5, putting Roth IRA conversions in the proper context within your overall financial plan. And even though we're taking a deeper dive into Roth IRA conversions, we'll still do our best to keep this higher level versus getting carried away and going too far in the weeds. Which I know we say this about a lot of planning topics, but this is definitely one of our favorite ones because of how big of an impact it can make.
I'm glad it's only taken us 45 episodes to fully embrace the bad dad jokes and how nerdy we both are.
Well, if we're being honest, I think we embraced that episode 1.
Yeah, that's probably true. I guess it just took us 45 episodes to publicly state it.
Yeah, that's a better way to put it. So now that we've publicly cleared that up, Trent, why don't you start us off with a high-level overview of what Roth IRA conversions are and why you'd want to consider making them in the first place?
Sure. So a good starting point is just a basic description of what a Roth IRA conversion is. And a Roth IRA conversion consists of converting, as the name implies, money from a traditional IRA to a Roth IRA. In this context, you can think of converting as the same thing as moving or transferring money from one bucket or account, a traditional IRA, to another bucket or account, a Roth IRA. And stepping back, it's important to understand the basic definition of the two accounts we're discussing here. So a traditional IRA is an account with pre-tax money, aka money that has not yet been taxed. The money in this account continues to grow tax-free over time, and then in the future, when you withdraw from the account, you pay taxes on each dollar you take out. A Roth IRA account, on the other hand, is one with after-tax money, or money that you've previously paid taxes on. The money in this account grows tax-free, and you'll never have to pay taxes on the money or the growth of it at any point in the future, even when you eventually withdraw from the account. So with those basic definitions out of the way, and going back to what a Roth IRA conversion consists of, you're taking money out of your traditional IRA account and moving or converting it to your Roth IRA account. By doing this, you pay taxes on each dollar you take out of your traditional IRA, but rather than that dollar going to your bank account where you can spend it, the money instead goes directly into your Roth IRA account. And once the money is in your Roth IRA, you can invest it however you want so it can continue to grow over time, and you'll never have to pay taxes on the money again in the future. So at this point, the logical question is, well, why would I want to pay taxes today if I don't have to and can instead push those taxes off into the future? And this is a common question, especially because the most opportune time to make these Roth IRA conversions is in retirement, which means you've spent the past several decades doing everything you can to lower the amount of taxes you pay each year, rather than proactively trying to accelerate the amount of taxes you pay. So it's not necessarily an intuitive concept or strategy, which is why it's helpful to understand the rationale behind making Roth IRA conversions and deliberately choosing to pay more in taxes today than you'd otherwise have to.
Yeah, intentionally paying more in taxes than required does seem counterintuitive. And there are 3 main reasons why you'd want to make Roth IRA conversions in the first place, which are 1, to pay taxes at a lower rate today relative to the future, aka minimizing your overall lifetime tax bill. 2, to lower the amount of required minimum distributions at age 72. And 3, legacy planning. And both 1 and 2 go hand in hand, but I'll start with the first reason, which is paying taxes at a lower rate today relative to the future. We've talked about this concept in other podcast episodes, including episode number 15 on minimizing taxes in retirement. But the goal in retirement is to create an overall tax plan that allows you to minimize your lifetime tax bill as opposed to trying to minimize the amount you pay in taxes during any given year. In retirement, which is different from your working years, you have a lot more control and flexibility over what your taxable income will be in a particular year. And the reason for that is because you're able to decide how you use, at least up to a certain point, the various income sources you have, like Social Security, and investment accounts, like your traditional IRA, taxable account, cash you build up in the bank, etc., to fund your retirement lifestyle. With that flexibility, you may realize you could pay $0 in taxes for 1 to 2 years of retirement simply by using cash you've accumulated in the bank to fund your retirement. Well, that may be nice for those 2 years, but may result in you having a surprise jump in your taxes in year 3 or at some point in the future, and ultimately result in you paying more in taxes over your lifetime. So the idea of making a Roth IRA conversion is you choose to pay more in taxes today than otherwise required, but note will result in you paying taxes on that money at a lower rate relative to what you'd expect to pay tax on in the future. And like I mentioned, this idea of paying taxes at a lower rate today relative to the future goes hand in hand with trying to plan around your required minimum distributions at age 72. Stepping back, this required minimum distribution at age 72 is simply the government saying you have to take a certain percentage of money out of your pre-tax retirement accounts. AKA, the government is saying you spent all these years avoiding taxes on your money, and now you need to start withdrawing money and paying taxes on it. So knowing you have to start withdrawing money from your pre-tax retirement accounts at some point in the future, the idea behind Roth IRA conversions has the double benefit of 1, paying taxes on a portion of that money today at a lower tax rate, and 2, lowering the amount of your pre-tax retirement money subject to those required distributions at age 72, which helps to smooth out your overall lifetime tax bill. And the last main reason to consider Roth IRA conversions has to do with legacy planning. As mentioned, Roth IRAs will never be taxed again in the future, including if the account is passed down to your heirs, whereas a traditional IRA is fully taxable to your heirs upon any withdrawals, similar to how it is during your lifetime. And there are varying requirements of how quickly your heirs would need to withdraw the money, but regardless of timing, it's passing on an account that your heirs will need to pay taxes on. So I won't go too far in the weeds here, but the idea of Roth IRA conversions and legacy planning comes down to looking at a generational tax plan of not just your lifetime, but also how to pass on the most money on an after-tax basis to your heirs. So step 1 is understanding what a Roth IRA conversion is, along with some of the main reasons why you'd consider making them in the first place. And step 2 is taking a deeper dive of the tax considerations to be aware of and what you'll need to review to determine whether Roth IRA conversions make sense for you.
Yeah, exactly. And as with many proactive tax planning strategies, it's rarely a black and white situation or decision, and you need to understand the other factors and considerations before determining the right strategy for you. This is especially true for Roth IRA conversions because there are plenty of situations where Roth conversions won't make sense for you based on your tax situation. I'll break down some of the other factors or tax considerations to be aware of as well, but at the most basic level, you want to compare your current tax bracket to what you expect your tax bracket to be in the future. For instance, let's say you're currently in the 37% tax bracket because you're still working and have a high-paying job. Well, what you want to do is compare your tax bracket today to what you expect it to be in the future. So in retirement, when you're no longer receiving your salary or income from employment, you'll almost certainly be in a lower tax bracket, which we'll use 22% for our example. In this scenario, if you're in the 37% tax bracket now, but you expect to be in the 22% tax bracket in the future, your current tax rate is much higher, so the goal would be to decrease the amount of money subject to taxes at your current rate, as opposed to increasing the amount of money you pay taxes on today. In other words, you wouldn't want to make a Roth IRA conversion where you pay taxes at 37% today, when you could wait to make those Roth IRA conversions in the future and pay taxes at 22% instead. However, looking at another example, we'll now assume you're retired, and based on your mix of investment accounts and funding sources for retirement, you realize you can manage your taxable income and fund your lifestyle while staying in the 12% tax bracket. If this is the situation, on one hand, it may be nice to not have a large tax bill for a year or two, but if you know you're going to be in the 22% tax bracket in the future, the next highest tax bracket, this is a scenario where a Roth IRA conversion might make sense because you could do that conversion today and pay the taxes on the money at a 12% rate rather than paying those taxes at 22% in the future, which means you'll ultimately keep more in your pocket when looking at your overall lifetime tax bill. So that's an overview of the biggest factor or tax consideration in a laboratory setting, where we assume that all other variables remain the same in the future as they are today. However, the reality is that tax rates change over time. That's where you'll need to consider the fact that it's impossible to know where tax rates will be in the future, and make sure you're comfortable with your plan regardless. So conceptually, understanding the rationale for making Roth IRA conversions is fairly intuitive, i.e. you want to pay taxes at the lowest rate when looking out over your lifetime, but actually calculating how it applies to your situation means you need to know what other variables to factor into the equation. And those variables you need to be aware of are 1, your income sources, Social Security, part-time work, real estate income, etc., and 2, taxable income from your investments, including distributions from your pre-tax IRAs and taxable interest and dividends, or realized taxable gains in your taxable brokerage account. Looking at those variables, we always start with the more predictable side, which is your income sources. If you're collecting Social Security, you'll have to pay taxes on up to 85% of your benefits, which, just to use simple math, if you had $50,000 of Social Security income, $42,500 of that would be reported as taxable income. If we assume that's your only income source, we now have a starting point in terms of what your taxable income will be for the year. From there, you can look at the second variable, which is what taxable income will come from the combination of your investments and how you withdraw from your various investment accounts to fund your retirement lifestyle. For example, you may realize that you'll have $20,000 of taxable income and dividends. So you can then add that to your taxable Social Security benefits to see that your expected taxable income is now up to $62,500. The last step is then looking at how you're going to fund the remaining portion of your annual expenses to see how that impacts your overall tax situation for the year. For example, if you need $100,000 for your annual expenses, how can you cover that remaining amount by withdrawing from the various accounts you have available, and how would those withdrawals impact your taxable income, which will be different depending on whether you withdraw from your pre-tax IRA, your brokerage account, etc. Once you get to this last step and understand what your expected annual taxable income is today, you can look at the current tax brackets to see where that falls from a tax perspective and what tax bracket you're in right now. So that's looking at how to back into the calculation of where you stand today from a tax perspective. The next part is then projecting out into the future to make a reasonable assumption for what your tax bracket will be later in retirement. In this scenario, it follows the same logic of looking at your taxable income sources and how, if at all, they'll change, and what your future projected taxable income will be from your investments, both taxable dividends and interest and taxes from withdrawals. However, a third component to factor in when looking out into the future is taking into account what your required minimum distribution will be at age 72, which is often one of the biggest surprises for people in retirement. So let's fast forward to age 72 and assume you have the same income sources at that point, $50,000 of Social Security benefits, with $42,500 of that being subject to taxes, and the same $20,000 of taxable income. Well, now you also need to add your required minimum distribution into the equation, which, just to quantify, if you have a $3 million pre-tax IRA balance, that amount would be $109,488. So adding all those figures together, you would expect to have around $172,000 of taxable income at that point. And based on that, you'll have a sense of what your tax rate would be at that time, assuming tax rates don't change dramatically between now and then. So the last step is then simply comparing your expected future tax rate to where you are today to determine whether or not a Roth IRA conversion makes sense in a particular year. And this is where it comes down to each individual situation and whether that expected future tax rate is materially different from where you are today.
Yeah, and then right after you have your calculations and plan in place, there's a tax law change, right?
Exactly. It can definitely feel like that at times. And that's why it's so important to have a plan to follow, but also remain flexible and able to adapt when things inevitably change.
Exactly. It'd be a lot easier if everything stayed the exact same.
Yeah, that would be easier, although too boring as well, right?
So now that Trent walked through those main variables, income sources and taxable income from your investment accounts, we'll dive a little deeper into how this changes over time through a couple different phases, which we refer to as key windows.
We like to keep it original, don't we?
Yeah, we don't want to throw people off from what they're used to with us.
Yeah, exactly.
So looking at the key windows, we break this down into 4 buckets. Retirement until Medicare at 65, age 65 until you collect Social Security, the time you start collecting Social Security until your required minimum distributions start at age 72, and then the catch-all bucket of everything else after age 72. And the reason we have these key windows is because there are additional variables that need to be factored in as you go through the various phases that impact how much, or if even making a Roth IRA conversion still makes sense. It also helps you to realize how important the timing can be if you're looking at optimizing your overall lifetime tax plan. Starting with the first phase, from retirement until age 65, this is the most opportune window because it's where you have the most control and least amount of constraints when it comes to making Roth IRA conversions. In this phase, you most likely haven't started Social Security. You don't have to worry about any Medicare premium surcharges based on income limits. You no longer have your salary from work, and you likely haven't had as many years of spending down your accounts, so you typically have a wider mix of accounts with varying tax treatment that allows you to have more flexibility with what your taxable income will be each year. The only caveat to add in this phase is that private health insurance is expensive, and there is the potential for tax credits from the Affordable Care Act, which is based on your taxable income. So it's another variable to be aware of when deciding your overall tax plan during this phase until age 65. But to avoid going too far in the weeds, we'll assume that it wouldn't make sense to pursue the ACA tax credit, and you instead are focusing on how to plan around funding your retirement paycheck and minimizing your lifetime tax bill through proactive Roth IRA conversions. In this window, it typically is the most optimal to fund your retirement paycheck with as little taxable income generated as possible, aka spending cash in the bank, using the interest and dividends from your taxable investment accounts, and minimizing taxable gains if you do sell investments. By doing this, it leaves more room or space to make larger Roth IRA conversions and pay taxes at a lower rate. This is especially relevant for those who calculate out a large required minimum distribution in the future at age 72. Now, it's important to add the caveat that this isn't specific tax advice, and the exact withdrawal strategy and Roth IRA conversion plan will vary based on your unique situation But the key takeaway during this phase is that it's the most advantageous time frame to make Roth IRA conversions. The next phase looks at the time period of age 65 until the time you start collecting Social Security. This is the next quote-unquote best window to make Roth IRA conversions because you haven't started collecting Social Security and thus continue to have more control over what your taxable income will be in a given year. The only added caveat here is that once you're on Medicare, there are certain income limits and thresholds that you'll want to factor in. And those income limits have to do with how much, if any, additional premiums you'll have to pay toward Medicare. Now, in practice, these surcharges are based on your tax return from 2 years ago, so it's not like you would immediately realize these changes in your Medicare payments, but nonetheless, at some point, you'd have to pay more if your income exceeds a certain threshold. So looking at 2022 as an example, and based on your 2020 tax return, if you file taxes as single and earn less than $91,000, or if you're married and file taxes jointly and report taxable income of $182,000 or less, you'll have $0 of additional Medicare premiums. However, if you report more than $91,000 or $182,000, there are gradual tiered increases in what your monthly Medicare payments will be, which range from $80 a month up to an additional $486 a month. So during this window, you'll want to at least factor in the potential for these Medicare premium adjustments when determining the amount of Roth IRA conversions to make. The third window looks at the time frame from when you start collecting Social Security until you turn age 72 and start having required minimum distributions. During this phase, you still have to plan around your Medicare premiums and be cognizant of those income thresholds, but now you need to factor in the additional Social Security income that's taxable to you. We view this window, at least in general, as the last key window for Roth IRA conversions, and is often why there is an added benefit of delaying Social Security until age 70 because it stretches out the number of years where you can make larger Roth IRA conversions. Obviously, this isn't a one-size-fits-all approach, and when it comes to Social Security timing, if you're interested in a deeper dive, we have an entire episode devoted to it, episode 35. But the reason we view this as the last key window is because once you have your required minimum distributions, along with your Social Security income, you end up having enough to meet your retirement lifestyle, and because of that, there are a more predictable phase of what your taxable income will look like from this point on. And once you're age 72, your taxable income becomes much more predictable, and thus results in there not being a need for Roth IRA conversions, especially if you took advantage of the first three phases. In this phase, the only potential variable change or rationale behind making Roth IRA conversions would be for legacy planning. In other words, you're choosing to pay more in taxes today so that your children or heirs inherit money that would be more beneficial to them from a tax perspective. So those are the four main windows and most common situations where Roth IRA conversions make sense, but we know there are some other unique situations, like during transition years from training to becoming an attending, where Roth IRA conversions could make sense, but those tend to be on a one-off basis.
Yeah, I don't think we'd be able to stick to our usual 20 to 30 minute podcast or keep people listening if we dove into all those possible scenarios. And I know we already went through a lot today, but one last thing we wanted to mention is that it's important to remember that Roth IRA conversions don't always make sense for everyone. And just because a tax planning strategy works for one person doesn't necessarily mean it's also the best for you. Also, with tax planning in general, we always like to add that you never want to let the tax tail wag the dog or try to get overly creative with these strategies solely for the potential tax benefits if they don't also make sense within the broader context of your overall life and financial situation. We know there are variables outside of our control, like future changes in tax rates and even the ability to continue making Roth IRA conversions at all, which is why we recommend setting up an overall 20-plus year retirement tax plan, looking at these key windows, factoring in your unique situation as to what you should do in any one year, then checking back in each year to see if any adjustments are warranted.
Yeah, exactly. And I know we can sometimes sound like a broken record, but it's important to face the realities of investing and financial planning versus hoping to find some silver bullet out there. And so to give a quick recap of what we discussed today, number one is understanding what a Roth IRA conversion is, which a Roth IRA conversion consists of converting, as the name implies, money from a traditional IRA to a Roth IRA. And you can think of converting as the same as moving or transferring money from one bucket or account, a traditional IRA, to another bucket or account, a Roth IRA. Step two is understanding why you'd want to make a Roth IRA conversion in the first place. And there are three main reasons. One, to pay taxes at a lower rate today relative to the future, aka minimizing your overall lifetime tax bill. Two, to lower the amount of required minimum distributions at age 72. And lastly, legacy planning. The next important area to understand is after you know what a Roth IRA conversion is and why you'd want to consider it, you want to understand the factors to consider when deciding if Roth IRA conversions make sense for you. Bigger picture, this consists of looking at your current tax situation and comparing it to your future tax situation starting at age 72 when required minimum distributions start. Number four, after comparing your current tax situation to your projected future tax situation, you want to understand the three key windows, which are from retirement until age 65 when Medicare starts, and thus need to plan around potential premium surcharges, from age 65 until you start collecting Social Security, and from the time you start collecting Social Security until age 72 when you're required to start withdrawing from your pre-tax retirement accounts. Those 3 phases are, in general, the most impactful windows for making Roth IRA conversions. And from age 72 and beyond, the main reason for additional Roth IRA conversions comes down to legacy planning. And lastly, as Trent just mentioned, and to tie everything together, Roth IRA conversions don't always make sense for every situation, so make sure you factor in everything we discussed and consult with a tax or financial professional before implementing a Roth IRA conversion strategy. Well, thanks everyone for joining us for another episode of the show. You can find the show notes at the podcast page of our website, mdwmllc.com/podcast. And if you have thoughts to share or questions you'd like to have answered, please feel free to shoot us an email at info@mdwmllc.com. Take care, everyone, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance reference is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.